Welcome to Slowdown Economics and the Return of Real Money. Sounds dramatic, and honestly, it is. Today we're looking at why gold and silver are being treated less like dusty relics and more like serious strategic assets. This is a story about currency, trust, and a major global portfolio reset heading into 2026. Markets don't vote with ballots. They vote with capital flows. When gold pushes higher and silver starts moving with real momentum, the message is usually clear. Confidence in paper promises is getting shakier. When trust in fiat weakens, hard assets get a second look. Markets can be polite, but they are never subtle for long. The classic 60-40 world starts to look like a model built for calmer decades. Central banks trimming treasury exposure while adding gold is not a random headline cycle. It signals a structural rebalance. Less counterparty risk, more balance sheet certainty. In plain English, the financial system is quietly tightening its seatbelt. Historically, the gold-silver ratio spent long periods near much lower levels than modern extremes. The point isn't nostalgia, it's valuation logic. For centuries, money was often understood through relative relationships, not just nominal price tags. History doesn't repeat on command, but it does leave fingerprints. In the U.S., the fight between gold and silver was never just technical. It was political theater with real economic stakes. Elections, legislation, and competing monetary philosophies shaped how people understood real money. That old tension still echoes today whenever hard money debates resurface. Money is economics, but it's also identity and power. Gresham's law in one line. Bad money drives out good money in circulation. If people view one form of money as weaker, they spend that first and hoard what they trust. That split between spending currency and saving currency is a key clue in stressed systems. Nobody parts with their favorite asset unless they have to. The gold-silver ratio can function like a stress gauge. Extremely high readings often align with fear, defensive positioning, and preference for monetary safety over industrial risk. When the ratio compresses, it can signal a shift toward silver repricing. It's not a crystal ball, but it is a useful dashboard light. Silver supply has a built-in rigidity problem because much of it is produced as a byproduct of other mining activity. That means higher silver prices do not automatically unlock a fast production response. In demand spikes, this inelastic supply can amplify price volatility quickly and brutally. Silver is not just monetary metal. It is deeply embedded in industrial systems, electronics, conductivity applications, and advanced manufacturing. If long-run demand keeps climbing, more silver gets consumed rather than quietly vaulted. That changes the narrative from store of value only to strategic material under pressure. Real yields are the quiet power center in this whole setup. When real yields fall, the opportunity cost of holding non-yielding metals drops, and gold and silver often benefit. Monetary policy, bond markets, and metals pricing are linked much more tightly than most casual commentary admits. Sovereign trust is the deep layer beneath all of this. Debt trajectories, fiscal credibility, and confidence in long-term purchasing power. Capital tends to migrate toward assets that are not someone else's liability. In that framework, gold is less about speculation and more about balance sheet insurance. Price targets for 2026 through 2035 should be handled as scenarios, not prophecies. The value is in regime thinking, inflation path, policy response, growth stability, and market liquidity conditions. The map matters more than pretending to know the exact mile marker. Markets adore humiliating, overconfident timelines. On a 2050 horizon, silver increasingly looks like a crossover asset, part monetary signal, part industrial necessity. If high-grade accessible supply tightens while technological demand scales, scarcity becomes both economic and geopolitical. That's a long-duration thesis, but it deserves disciplined attention now. Mental bimetallism doesn't mean paying for coffee with coins next week. It means investors rebuilding a two-anchor mindset: monetary resilience plus real asset exposure. Or, put differently, think a little more like a central bank, with risk controls instead of romance. Gold as a top-tier reserve asset and silver as a hybrid monetary industrial metal form the core idea here. Watch the ratio, watch real yields, watch policy credibility. Those three lenses explain more than most hot takes ever will. Test the thesis, pressure test the data, and size risk like an adult.